So first, a brief history of debt in the U.S. 1995, it stood at $5 trillion. 2005, $8 trillion. 2015, $18 trillion. 2025, $37 trillion. And the estimates by 2035 is going to be $80 trillion. That might be a low number because we've got a lot of inflation that's going to be coming. Now, debt used to rise more slowly prior to the great financial collapse of 2008 when the Fed launched QE programs, and since then, debt roughly doubles every decade. Every nation is in debt to the tune of over $300 trillion if you take the aggregate, and this is some 300% of global GDP. The debt is never repaid, but just gets rolled over as governments let inflation do its job. To prevent the printed money from spiking CPI and the PCE, the government encourages inflation of asset bubbles to soak up the money supply, and stocks, real estate, and gold and Bitcoin do this handily. This debt Ponzi scheme will continue until its final destination of hyperinflation. But it is also possible that due to the material increases in AI-based productivity, the aim is for the world to grow out of its never-ending debt, as they did post-World War II, when the whole world was mired in debt. Now this year, the U.S. raised the federal debt ceiling by another $5 trillion to accommodate Trump's latest package. And you can also count the $1.4 trillion equivalent surge in Chinese liquidity this year, and the increasing use of short-dated treasury bills to fund America's federal deficit. Global debt surged in 2008 during the GFC when $5 trillion was created. Then again in 2020 when the COVID emergency digitally printed $35 trillion. And monetary inflation hedges, including stocks, gold, and particularly Bitcoin, have performed. And this is underpinned by the rising global liquidity. And all of this is why bear markets are always temporary, so should be embraced, whether the greater, well, I'd say where the greater the deviation you have from the high, the greater the buying opportunity being presented. Of course, that is tricky timing, and the saying, don't try to catch the falling knife, because bear markets can be pretty brutal. And you don't know necessarily how far down they're going to go. We also see real estate. That's another bubble waiting to burst. The bubble popped in the early 90s after a roaring 70s and 80s, and then real estate soared in the 90s, and then it had a bursting bubble in 2008 due to the GFC, and that sent prices crashing for the next couple of years. But since then, it's been soaring once again. So as long as global liquidity remains healthy, real estate correlates fairly well. Now, as far as the stock market being overvalued, we're seeing that more than 1 out of every 4 companies in the S&P 100 have a PE above 50, and 2 out of every 3 companies have a PE ratio above 30. So that's not normal, but it's also not normal that the Mag 7 has actually become cheaper so far this year due to major earnings beats despite their dramatic rises in price. The S&P 500 and NASDAQ Composite continued to telegraph that investors are bullish, so these things so far, I mean, they're undergoing correction now, but overall they've been hitting new highs, and we've got more QE, and lower rates are likely despite the inflationary issues. And the reason is because when they slashed interest rates to 0 during COVID, and by the way, this was never heard of in over 4 millennia of world history, according to Sidney Hummer's A History of Interest Rates. So borrowers during COVID were incentivized to borrow more and to term out their existing debts into future years. And so that lowered the effective debt to liquidity ratio. And these debts now make up the so-called debt maturity wall that is slated to be repaid through 2025 and 2029. So as of July 2025, about 31% of U.S. publicly held marketable debt is set to mature within 12 months. And the total amount of outstanding debt stands at over $9 trillion of treasury debt that matures this year. So this creates a large refinancing burden, but the U.S. Treasury has several strategies to manage it, such as focusing on short-term T-bills to avoid locking in high long-term interest rates. Now, the success of this strategy depends on the assumption that interest rates will be cut by the end of 2025. Right now, CME Fed Futures is projecting 2 rate cuts, but of course that's data dependent. And the Fed is under pressure despite inflationary concerns. Now, this global liquidity party in risk assets may not end soon, but we all know that it never ends well. The can gets kicked down the road until a major debt funding crisis emerges. And to ensure financial stability, more debts demand more liquidity from policymakers. So the key role played by global liquidity in refinancing debt means that it comes down to judging how fast our future debts will grow. Fiscal dominance forces central banks into ever greater monetary inflation. And in this world, hard assets, stocks, Bitcoin, precious metals, and real estate make great hedges until they don't. But that said, the last century of price data on the Dow shows that markets always rebound. The deepest correction by far was in the 1930s when the Dow lost 90% of its value, though interest rates and liquidity guided markets sharply higher. Even back then, after the Fed conducted large-scale open market operations from April to June of 1932, and that significantly increased the money supply by about $1 billion back then. So this was a form of QE aimed at providing liquidity to the banking system and stimulating the economy, which in turn helped lift stock prices when the Dow doubled in just a few months from June 1932 lows. So the macro aspects of liquidity have always worked in guiding general market direction. We also had the 78% correction in the NASDAQ composite, which was its steepest drop by far, and that was after the dot-com bubble burst. And that was also not coincidentally with the liquidity slowing up, after which it took 15 years for the index to hit new highs once again. But the role of buying leading stocks and leading industry groups once global liquidity starts to accelerate, such as in early 2019 and early 2023, holds true. Meanwhile, when global liquidity slows, it's time to go short or sell, at least, very least, such as when the Fed ended each of its QE programs in the 2010s, in 2016, in 2018, and in 2022. So I would also just add here that this longer-term approach to catch the meat of the major moves, of course, does not apply to shorter-term or swing traders who can enhance their returns by using our various techniques, such as pocket pivot, viable gap up, undercut and rally, and short sales setups. And certainly right now we've got a market under distribution, so pick your spots wisely, and of course have risk control under management, because when we bounce, we tend to bounce sharply. But right now, things are looking pretty heavy to the downside. Gil, how are you seeing everything?
Yep. We got 2 days down hard, but we started rolling over a few days ago, and it's basically the market realizing that the AI, and we were talking about this last week, the whole AI thing is overbuilt. Meta Platforms announced yesterday that they're scaling back, and of course that helped trigger a sell-off, along with comments from OpenAI CEO Sam Altman that you're looking at a bubble like the dot-com bubble. And it is very similar. We've already talked about this ad nauseum, right? So no big surprise that you're seeing it start to come to fruition. And the simple thing to do is go after some of these leaders that are breaking down on the short side. And we've seen that over the past few days, such as NVIDIA coming through the 10 and the 20 yesterday. That was a short. Cisco last week was a short. Even I noticed some of these names like Iron, and this is something that struck me over the weekend. Whoop, let me see if I can get this up. There we go. What struck me about this is, okay, now you have all these crypto miners are going to become data center operators. To me, it smacks of saturation. In other words, when everybody on the planet is suddenly going to shift their business and become a data center operator, provider, service provider, whatever, maybe you're at a saturation point. And I think that's what this sell-off is over the last 2 days. So, NASDAQ down at the 50-day line, I'm guessing, or that's the NDX. Let's see what the NASDAQ did. Probably roughly the same thing, not as far. So you can see it's mostly centered in the big stock NASDAQ names. The S&P trying to shake out at the 20-day line. I think you got further to go. I think you'll get to the 50-day line before you see any kind of oversold bounce. So in the meantime, you could just spray the market with inverse ETFs, right? So things that worked nicely yesterday. the skews, this morning they actually could have been bought and you would have made some money here, about 80 cents to the peak. Now coming back in, which makes sense. But yesterday it was the same thing, steady to the upside all day long. And that I think makes it a lot simpler than trying to go after individual stocks, because, you can short semiconductors when they all start to break down together just using the SOX S. So that's worked well over the last 2 days. And now you're getting a little long in the tooth short term. So you're bouncing. You see like Broadcom, for example, bouncing off the 50-day line. That makes sense. So you are in positions in some cases where they may try to hold support temporarily, and then we'll see what happens from there. But, things like Lam Research, that was a short above the 20-day line today. It's rolling over. Microchip could turn out to be a short along the 20-day line, but you notice it's trying to bounce. I also think Meta Platforms tried to give the market some boost by announcing that their first data center just went online. And well, that was going to happen. So why is that such a big thing? The question is whether all this money they've spent to build more than just their first data center produces real profits, right? And we know that, like Sam Altman said, confirmed yesterday or the day before, they're bringing in 20-something billion dollars in revenues a year, but they can't make a profit. So it just tells you AI is an expensive proposition. So, that's going to trigger, there will be people seeking solutions to that problem, and that's how it'll evolve. Just like people had to figure out how to distribute internet or video over the internet in the mid 90s, and that's what got that all rolling. So there were barriers, right, that had to be overcome. But that sparks newer innovation. So you see how the whole thing, it evolves. And I think the AI thing is the same way. It's going to be a big deal like the internet. But if you think about it, the internet in 20 years or so has really impacted our lives massively and meaningfully, and in a way that AI has not yet. So don't make too much of AI too soon. That's what I would say. And I think that's what Sam Altman was trying to say. But I think he was just being a sensible voice among what's becoming a lot of hype, and where you're seeing a lot of these little companies now being drawn into wanting to offer AI data center services. Anyways, there's Micron breaking the 50 today. So you can just see these all over the place. Some of these were shortable this morning, but it's a touch and go thing at this point, because you're down a couple, 3 days and you're getting a little bit extended where you can bounce. So you just kind of have to play things close to the vest. If we look at, say, big stock NASDAQ names, which had been leading the way. You see Alphabet continuing to rally right into last Friday, right? And same thing with Amazon, even on as recently as Monday, and that's rolling over. So these are all starting to come in, and I think they should come in further. That said, you could get an intraday bounce here. You already have, because you're about halfway. That's on the NASDAQ futures. I think we're about a little less than halfway off the lows. So we'll see whether that's just a natural reaction. Then we roll back down heading into the rest of the day. But it's pretty obvious here. Intel, the government wants to take a stake in Intel. I really think that's just such a bad idea. The U.S. government does not have to start owning tech companies. That's called nationalization. That's what dictatorships do. That's what tyrants do. Just let the free market do what it's going to do. You don't have to prop up companies by taking positions. $10 billion, whatever it is, it's going to be. I think that's what they're throwing around. You don't need to do that. If it's a good company, it will make it on its own, So I think Trump is a little bit like, he's basically a liberal in sheep's clothing. He's a centralist in sheep's clothing. He wants to control everything. And so buying up companies, tariffing everybody, that's his way of exercising control. So I don't think it's a good idea when it comes to Intel. Meanwhile, Meta, you can see finding support near the 50-day line. So a lot of this looks logical to me on an intraday basis. But the last couple of days, heading into the panic this morning, have been very profitable. Here's Tesla triggering a short at the 200-day line, but also now below the 50-day line. So Elon Musk was out the other day threatening shorts that when they fully get to full scale on something or another, on autonomy, they're going to destroy the shorts. Well, okay. We'll see what that looks like when it happens. But I think it's just bluster. Anyways, the stocks are short right now. You look at big stock clouds. Finally, we saw Oracle come off. But we've been seeing a lot of these cloud's coming off for a while because AI is going to infiltrate and supplant a lot of the functions of software as a system products, like what Salesforce has, like what Workday, ServiceNow have. And so now Oracle, which kind of reinvented itself, at least in the near term, as a data center provider, service provider, and accentuating that in their last earnings report, that's what's been, it's been riding on. And so finally that's starting to come unravel and finding support at the 50-day line. Cisco is the same thing. Oracle has putrid earnings and sales. Cisco has putrid earnings and sales, but both stocks have been rallying on the promise of, AI, of shifting their businesses and pivoting more towards AI data centers, which is now starting to come unraveled. But Cisco started coming unraveled last week. Where was I with these big stock clouds? Let's see. So ServiceNow, I mean, that could potentially play out as a short there at the 20-day line. Some of these might try to rally simply because maybe they think the pressure is off if AI is not going to expand as quickly as maybe some of them feared. But I still think, like Workday was a short at the 50-day line, may still be. Zscaler a short at the 20-day line yesterday. And where you don't see, like Salesforce, possibly a short here at the 20-day line. Palantir blew apart yesterday. So there you go. There's another AI name. So, the bloom is coming off the rose here. And I think it's part of a natural process of creation and destruction. I get comments from people, I believe in AI. So, okay, great. Do you remember, Chris, back in 2000, when all the hedge fund guys we had who, they believed in the internet and they were going to hold their stocks all the way down, and a lot of them did, and then they went out of business. Remember, we were over at Archery Capital, and they had just hired an internet analyst from Merrill Lynch, paying him $1 million a year. And we went through their portfolios, a bunch of garbage, blowing apart all these internet names. And of course, we tell the story in the book, Trade Like an O'Neill Disciple, how we're sitting there, and we brought Mike Webster with us as an assistant. So we had him doing all our grunt work for us. But we brought him along. I brought him along, had him sit in the back, and we're going through all of their charts of their holdings. And Mike's in the back, whispering to himself, that's topped. And every time that he would say that, the internet analyst, the $1 million internet analyst would harumph, like, yes, Mike doesn't know anything. He knows how to read a chart, I'll tell you that much. And of course, those things. Go ahead.
Looked at Mike, like he's just this, dumb kid or something, or, ignorant, and, he's expert because he's, he's made it in his career. But, sometimes that works against you because, he couldn't see the forest for the trees. And so, but they lost money, and that was the nature of that bubble. But what triggered it was, they started hiking rates, and that, again, global liquidity, had I been tracking it then, certainly it showed that it was slowing up. And so when you slow up global liquidity into a bubble, you're going to pop that bubble pretty fast.
Yeah. And that's how that went. And, it's all part of the cycles that Bill O'Neill had seen it before, and we saw the climax tops in March. Everybody sold into it. We all made a ton of money. And then we got out, but all these hedge fund guys, these smart hedge fund guys, they just held on to the bitter end, and a lot of them went out of business. I was writing this morning that it got so bad that me and my institutional advisory reps, we'd see these hedgies go out of business. And like, well, what happened to this account? Oh, they went out of business. So after a while, it just became, what happened to this account? Well, they got oobed, OOB. Out of business, basically meaning that they held a bunch of internet positions down to nothing and they blew out. So it was an exciting time, but you had to be there. So I think the same thing will happen here. And ultimately it's a good thing for technology to progress and wash out, and also for the market to reset. So I like it. Anyways, what else is looking at crazy out there? Let's see. Telecoms were also moving on the same thing, but see, they're coming apart. Arista Networks or Arista Networks are going to short at the 10-day line, trying to hold the 20-day line. We'll see if it busts. Sienna busted the 10-day last week. Now yesterday, the 20-day. We already talked about Cisco, but Coherent blew up after earnings. So there are a lot of signs that we're starting to come a little undone in the AI space. Credo Technology, another data center name, breaking through the 10-day line last week. Okay, so this didn't just happen. So you'll hear in the media that, oh, Sam Altman caused the market to sell. No. He didn't cause it to sell off. It was already starting to. And there were clues, and I'll go through some of this. But anyway, so like, for example, where's my AI data center power and infrastructure names? Okay, look at Centrus Energy. This was one. Their uranium refinery, a double top reversal up here 2 weeks ago, and it's gone straight down from there. Coherent, that's another one that's in there. Constellation Group, an energy utility, okay, a lowly utility. This thing topped last week when it flipped out at the 20-day line and the 10-day. Eaton, another electrical power equipment. So that one gapped down after earnings, and now it's continued to go lower. So these things were already coming apart, a while ago. Again, I'll repeat that. GE Vernova, this has been one of the better names. They build nuclear reactors, but guess what? It takes several years to build a nuclear reactor, much less make big profits, I suppose. But that one rolled over last week. Iron, this is one we liked, okay? And we got a nice move after we talked about it right here. It had a nice move right up to the prior highs, but it's the same thing. And this is one that I wonder whether it's a barometer of the hype where now a former Bitcoin or crypto miner suddenly decides they're going to take their compute power and use it for data centers. Okay. We'll see how this plays out. I mean, technically, that's an undercut and rally at the 20-day line, a pocket pivot, but is it going to hold up? I actually shorted this thing yesterday and covered it this morning for a nice little 10% profit, so that worked. NextEra, another one, utility. Maybe that's just going to double top. NRG, they've got an NRG plant right here by my house down here in Manhattan Beach. El Segundo, Manhattan Beach, the border between those two beach towns. It's a utility. I don't understand what they're going to do. Are they going to jack rates up to the moon? That's going to create an outcry. And if they're doing it to sell energy to AI data centers, local populations aren't going to stand for it. That's why you've seen one project in Texas got blocked. So anyways, notice how we're rolling lower again. Vistra, another one, power generation utilities. Okay, look at that. Breaks the 50-day line. Now you're rallying into the 50-day line. So does it become a short there? If we look at some other things, like something that occurred to me as well, is that if we look at industrial metals, specifically coppers, okay? So if we look at, say, start with Euro Copper, this one's been going down because of Trump's sanctions on Brazil. It's a Brazilian miner. But Freeport, after he put the tariffs on, it had a brief rally and then reversed and then broke down when on some other tariff news, I forget what that was. But you haven't seen copper come back since, and it's staying down. And what happened to all this copper that we were supposed to use or needed for data centers? And why is the price of copper still flat on its back? The chart looks similar to Freeport. But if we look at copper prices, I'll look over here on stock charts. You can see the break, and it hasn't rallied back at all. And that's the largest single-day break in copper futures in history. So what is that telling you? Anyways, so that was another clue, and I thought, well, if we're going to need all this aluminum and steel to build all these power plants for data centers, and well, why is this coming off? Why is Steel Dynamics looking like a short at the 200-day line? Why is Southern Copper flipping out at the 200-day line yesterday? And we can go now. The other thing is they're gonna hire or build small modular reactors to have on site. Okay, and so that was positive. I mean, the nuclear power thing was positive for uraniums, which Camco, which is the big stock leader in the group, blowing apart. Okay, Energy Fuels blew apart yesterday. Lightbridge, Air consulting firm, they blew up after a nice move last week, I believe. Nano Nuclear, they build small modular reactors. They blew up a few days ago. But notice how you had this double top reversal here. That was a short entry. Boom, right there. And then it based for a little bit. And now just blowing to pieces. Next Gen Energy, another uranium company, blew through the 50-day line yesterday. NuScale Power had blown up last week after earnings. I think it actually blew up like, almost 3 weeks ago. That would have been the gap off the peak, I believe. And then it was a short along the 20-day line. Then it busted the 50-day line last week, I guess. No, that was a couple of Fridays ago, I think. But still going lower. So, the clues were there. Okay, it was kind of in your face. So I was skeptical. That's why last week I'm talking about how this whole AI thing is probably done. Excuse me, done. So there you go. Any hot questions? Now, one thing I noticed, Gil, do you have a max position shot? Yeah, whatever my buying power is, I go all the way in. So you can't. Don't worry about what I do because you're never going to do what I do. Okay, if I feel very aggressive, I'll go 200% long or short something, just like I'll go 200% long something, and then I know how to handle it. You don't. So knowing how big of a position I take is meaningless to you. So people always want to know that, well, how big of a position do you take? As if they're looking for my recipe, somehow they can follow. You can't, because I may be gone and out of that position twice and back in twice during the same day. So, it's not, I don't take such a static approach, especially in this market. So, but a good question, one that's commonly asked. So, what else? I think that's the only question I got. One area that's holding up that I think is interesting. Well, last week also we saw Bitcoin. I saw the big reversal. I thought that looked like trouble. It tried to hang on the 20-day line, but notice how there was no volume. So was that selling drying up or just no buyers showing up? It looks like it was no buyers showing up because now Bitcoin has busted the 50-day line. Meanwhile, if you look at gold is actually up today. What? $25. So it's back up. It's reversing yesterday's decline, coming back up to the 50-day line. But as we pointed out over the weekend, all that's happening here is it's in a pretty tight base. We'll see how that plays out, because in the past we've seen gold sell off with the market and then recover before the market. I'm just wondering whether in a case like this, what am I doing here? Yeah, I think I'll just show the SLV because it's. So here we go. Wait, what the heck is that? I'll get it right someday. Yeah, there we go. So it's bouncing off the 20-day line, or the 50-day line rather, and it's basically basing. So we'll see where this goes. What I think is interesting is you've seen a bid under some of the miners this morning. We'll see where that holds up. I see that mostly as a safe haven type of bid. But we can peruse the groups. So here's gold miners, Agnico, that's holding 20-day support, so that's constructed. Alamos just hanging, Eris Mining just hanging around the lows. It's actually up to Anglo Gold, shaking out perhaps at the 20. We'll see. Barrick Gold making new highs. There you go. B2 Gold pulling back into the 10-day line. Eldorado holding tight on a voodoo pullback to the 20-day line. Equinox Gold, this is one that was on fire last week after earnings. That's holding tight. I actually bought some of this near yesterday's lows. Fortuna Mines now, they're accentuating or emphasizing the gold side, but you're getting a 5-day pocket pivot supporting volume signature here at the 20-day line. Goldfields coming in lightly. There's gold just hanging out again. Harmony, a voodoo pullback, looks like into the 20-day line. Well, not quite, almost. IM Gold, but you can see most of these are holding up pretty well. So they're not coming apart. Does that mean they won't come off later? I think if you see the market really start to break, then the danger is that you get forced selling that takes everything down because everybody's got to sell stuff to meet margin calls. And, at that point, anything that isn't nailed down is likely to get sold. What will be interesting to see is whether we see the miners hold up. Because I think you are in a new age for gold with the central banks continuing to buy. And so, that could, with gold miners trading at absurdly low valuations, the market may say, oh, this is a good place to hide. So it gets money flows coming from other areas like AI and tech and other higher valued, higher P expansion areas of the market. But there's no guarantee necessarily that it's going to result in big upside. They may just hold up. We'll see. So that's something to watch for. And it would be a little bit of an aberration to see these hold up in the face of a deepening sell-off. But, I'll play them as they lie. So I picked up a couple this morning. Yesterday I was in these and I blew out early in the day once I could see what was going on. And then they come in a lot of times. So, for example, you look at, say, I'll go to the silvers. Now, silver, I'm a little concerned because silver is supposedly going to be used for all these electronics we need and power and nuclear power plants. But if all that is not going to be as great as people think, then maybe demand for silver drops off. So we don't have as big of a deficit. But that said, some of these silver miners are hanging tight, trying to hold support. I look at First Majestic. I think your 50-day line is at 848. We're sitting at 849 right now. So I don't know. I've got this one. We'll see if it holds. But I'll bail if things do not hold up. That said, we might get a bid there. We'll see. But and the other thing is with the market, with the indexes somewhat oversold, a lot of these AI techs and other techs somewhat oversold, the possibility of a bounce might bring these back to the upside. So I don't know. We'll see. It's a very fluid situation. But bottom line is, if you're long anything, better review your risk management plan. What are your trailing stops? Are you using a particular rule like the 7-week rule to sell stocks? Example would be Oracle, which will come up someday. So you can see that once it started moving back here in the latter part of May, got above the 200 and then gapped higher, it has obeyed the 10-day line. Well, it finally violated it, I think, yesterday. And so that at the 20-day line, at the 10-day line, as it violates it, that becomes a sell signal using the 7-week rule. So, what is your risk management plan? Or are you going to be like these hedgies that we knew? If this does come off further, we don't know yet for sure, but we just trade what we see in real time. But if this comes off further, are you just going to sit there? So what's your risk management plan? Anyways, that's all I got to say. Anything else, Chris?
I'll just close with the dot-com bubble. We know these bubbles can get extreme before they actually burst. And what pricked the bubble was liquidity. It just started to slow up because of the Fed, because they overshot because of Y2K. So they had to reverse that. And as always, I'm going to be watching global liquidity because that's going to dictate overall the movement of the markets. Now, this is a longer-term strategy. So for those who want to sit and hold Bitcoin and track it based on liquidity, that's done very well. It's tracked very well over the years. But obviously, our site caters to many of the traders, and both obviously Gil does, and I do too sometimes, using these techniques, which are much shorter-term oriented. But keep in mind that the Magnificent Seven is not UBID or pets.com. I mean, there's some real problems that are being solved. Even I was surprised that David Sinclair of Harvard put his reputation on the line, saying just a few weeks ago that in 10 years or less, you'll be able to take a pill and get younger, because he's been able to finally make that massive breakthrough. And the reason is because of the AI surge, which has enabled his research facilities to do orders of magnitude greater than they were able to in the past. So this is affecting medical quite pronounced in a pronounced way. And we've got also the businesses that are shoring up larger margins and everything. So let's see how this rolls out. But global liquidity, I think, will be the final arbiter of major market tops.
Okay, thanks for showing up, everyone. We'll catch you next week. Take care.
So long, everyone.